Velocity banking is typically referenced with a focus on paying down an individual's mortgage. But the truth is, the strategy expands well beyond mortgages and can be quite powerful if used to pay off other kinds of debts, such as credit cards. And although using velocity banking to pay off credit card debt can seem like it's only relevant for those with substantial credit card debt, the truth is the strategy can still provide value to individuals who may not have extensive credit card debt. So in today's video, we're going to take a deeper dive into using velocity banking to pay off one's credit card and how to optimize the strategy to get the most value out of it. So before starting velocity banking with a credit card, the first thing that an individual needs to have is an understanding of their monthly income and expenses. This will give you insight into what your monthly cash flow situation is. Whether your monthly cash flow is negative or positive, velocity banking with a credit card can still provide value. But the truth is, for those with a negative cash flow, the potential risk might greatly outweigh the benefits that can be seen from the strategy. To better understand the risk of using velocity banking to pay off a credit card while having zero cash flow, I first recommend watching our video on this topic, which we will link below down in the description. To better understand the strategy, let's look at an example. Let's imagine that Joseph currently has $4,500 in monthly income and $3,750 in monthly expenses. This leaves Joseph's monthly cash flow at $750. Joseph also currently has a credit card with a balance of $10,000 that carries an interest rate of 22%. Right now, Joseph's current strategy for paying down his credit card is to take his monthly cash flow of $750 and make a monthly payment onto his card. So in this example, we're going to take Joseph's current situation and look at ways in which he can optimize the way he's paying his credit card to achieve two main things. One, pay off his credit card faster, and two, while paying this card off, pay less in interest. We will then compare Joseph's current strategy to the velocity banking approach to get a clear understanding of the potential value that velocity banking can provide. To optimize the payment of his credit card, Joseph will first need to evaluate his monthly expenses to see which ones can be paid through his credit card. Most commonly, things such as rent, utilities, and car loan payments cannot be paid onto a credit card. And this is really the first area where Joseph can optimize his repayment plan by trying to maximize the number of his expenses that can be paid through his credit card. Of course, we do recognize that in a lot of cases, it's going to be out of a person's control whether or not they can pay an expense onto their credit card, but all options should be explored. For example, rent is a payment that people can typically not make onto their credit card. However, certain credit cards do allow you to make rent payments onto the credit card, such as a Bilt card. So in Joseph's case, it may be worth him investigating whether or not he'd be able to transfer his credit card onto a card like Bilt that would allow him to pay his rent onto this new card. So why is all this important when it comes to optimizing the way Joseph pays off his card? Well, that's because with velocity banking, Joseph is going to be taking all of his monthly income minus any expenses that cannot be paid onto his credit card, such as his utilities, and immediately make a lump sum payment onto his credit card. Then, for the remainder of the month, Joseph's card will essentially serve as his checking account to pay all of his expenses. In Joseph's case, $2,750 of his expenses are eligible to be paid onto his credit card. So what he will do is leave $1,000 in his account to cover his expenses that cannot be paid onto his credit card, and take the rest of his income, which is equal to $3,500, and make a lump sum payment onto his credit card. What this has done is it's immediately lowered Joseph's average daily balance, which is the calculation used by banks to determine the monthly interest charge on a credit card. But he isn't done yet, and that's because there's still more he can do to further lower this average daily balance number. Next, what Joseph is going to want to do is to try and pay as many of his expenses as possible towards the end of his credit statement. For example, if Joseph had a statement period between December 14th and January 15th, the ideal situation for Joseph would be to pay all of his expenses on January 15th, right at the end of the statement. And yes, we understand that this ideal world is not going to be possible in reality, but most people will likely have expenses that they can move towards the end of a statement period. In Joseph's case, let's imagine that he gets to a place where all of his monthly expenses come out equally throughout the month or payment period. So as previously mentioned, the first thing that Joseph is going to do is he's going to take $3,500 and make a lump sum payment onto his credit card, bringing his balance down from $10,000 to $6,500. But of course, Joseph will still have $2,750 in expenses that will need to be paid onto his credit card. After paying all these expenses, at the end of the month, Joseph's balance will be brought back to $9,250. So let's pause here and compare this to Joseph's current strategy, which is just allocating his monthly cash flow onto his credit card. In this example, at the end of the month, his balance will also be $9,250. So what is the difference between these two scenarios if we ended up in the exact same spot? Well, that all lies in the average daily balance. So Joseph's current situation or strategy, since he is making a payment at the start of the month, but not making any additional purchases on his credit card, his average daily balance will be $9,250. At his interest rate of 22%, this will leave his monthly interest charge at $169. But with Velocity Banking, Joseph will be able to attain a lower average daily balance since he is putting all of his income onto his credit card and then paying all of his monthly expenses throughout the month onto this card. And as previously mentioned, his expenses will be coming out equally throughout the month. This will then leave his average daily balance right around $7,875. At the same interest rate of 22%, this then leaves his monthly interest charge at $144. This equates to a savings of $25 on the monthly interest charge in month number 1. But this isn't the only way Joseph can optimize his repayment strategy. Most credit cards carry some sort of element of reward points or cash back. In Joseph's case, he earns 1.5% cash back on all purchases. So by virtue of making all of his payments through his credit card, he will earn an additional $41.25 in monthly cash back. This will then bring his total savings from the Velocity Banking strategy to $66.25 in month 1. And of course, it's important to note that this is only an example. This monthly savings amount could be much higher or lower depending on many factors such as the person's monthly cash flow, the number of expenses they have that can be paid onto a credit card, when those expenses are paid, and of course, the amount of debt and interest rate that a person has on their credit card. As well, along with the Velocity Banking strategy described in this video, using it alongside a 0% APR transfer balance offer can make it even more powerful and potentially result in greater savings. For more on how this can enhance Velocity Banking with a credit card, check out our video that takes a deep dive into this topic. We'll leave a link down below in the description. All in all, Velocity Banking to pay off credit card debt can be extremely powerful and potentially offer financial benefits that can be attained through minimal effort. But that's not to say there is no risk with this strategy, with one of the biggest risks coming from the fact that a person will be paying all of their expenses through their credit card, which in turn will open up additional room on their credit card, which of course should be strategically used to pay their expenses. But if this person is not able to control their spending, they could quickly leave themselves in a much worse place than where they started. For more on the risk and scenarios where it might not be ideal to use Velocity Banking to pay off credit card debt, check out our video on this topic, which we will also link down below in the description. Before we go, our one ask is that if you did get value out of this video, be sure to leave a thumbs up and consider subscribing to the channel for more content related to Velocity Banking and everyday finance.